This is Paul Donovan from UBS's Global Economics Department. There are 5 key points to be made in the current crisis. First, a modern capitalist system cannot function without a properly functioning banking and financial system. Second, a functioning banking system requires financial institutions to trust one another and to lend amongst themselves with appropriate regard for the fundamental risk. Third, the current environment is one of disorderly markets, irrational wealth destruction, and unstable equilibrium. The situation is in equilibrium because the system cannot get itself out by its own means. It is an unstable equilibrium because it is self-destructive. Concerns about debt rise, so assets are sold to cover debt, causing asset prices to fall, causing concerns about balance sheets, causing concerns about debt to rise. Fourth, in a systemic failure like this, a systemic response is required. Bailing out individual institutions will not solve the crisis, and as AIG has demonstrated, it may well make the situation worse. A comprehensive government-sponsored plan for the system as a whole is needed. Fifth, as well as resolving the balance sheet problems of the banking sector, there is also a need to resolve the balance sheet problems of the borrowers. Now for the good news. This cannot go on much longer. The unsustainable nature of the crisis requires some kind of solution. What we believe to be required was set out in a global economic comment published earlier this week. Capital injections, a government guarantee across the board for bank deposits for a set period of time, and interest rate cuts form part of the resolution. What are the consequences and limits of the current situation? First, it should be absolutely clear that the current injections of liquidity by central banks are not inflationary. Liquidity demand has shot up. Liquidity injections are barely meeting that increase in demand. Money supply does not cause inflation. Excess money supply causes inflation, and we do not have excess money supply at the moment. There is an expansion of liquid money supply to offset a contraction in illiquid money supply. It may be that excess money supply is a problem in 2 or 3 years' time, but there is no need to worry before 2010. The longer the current situation continues without resolution, the greater the risks of deflation. Anyone out there who still considers stagflation to be a viable outcome needs to stop taking the hallucinogenic drugs, or perhaps, given the stressful market environment, to start sharing. Second, governments, and in particular the US government, do have the resources to deal with the crisis. Talk of balance sheet constraints, of government credit concerns, and the like are nonsense. We are in a fiat currency system. If every asset has to be liquidated, it can be. It will not be pleasant to experience, but technically it can happen. In terms of the near-term specifics, in the wake of 3 money market funds breaking the dollar or failing to preserve the capital of their investors, 3-month T-bills are now trading at 7 basis points yield. Investors will fly to T-bills if they do not trust money market funds or bank deposits as the last liquid home for large sums of cash. If we take the low level of T-bills as a guide to the market is pricing in no stabilization for 3 months, but it believes there is a chance of system stabilization within 6 months, albeit a declining chance. 6-month T-bills are around 80 basis points. They fell 64 basis points in yield yesterday. Commodities are generally weaker across the board as the economic consequences of the credit slowdown becomes ever clearer. Gold has seen some profit-taking as well after yesterday's massive leap. The relative performance of the currency markets is somewhat instructive. The dollar is weaker. Clearly, in a risk-adverse environment, home country bias will be important for investors, and that will be a negative for a deficit country like the United States. However, there has been no gapping on the major currency pairs. That suggests that leveraged carry trades, especially the yen carry trade, do not exist in size today. To date, this is nothing like the 1998 situation when dollar-yen moved over 16% as carry was unwound. Fundamentals now, temporarily, are irrelevant. Irrational markets do not pay attention to economics or to economists. Of course, when economists are ignored, bad things happen. Bad things will keep on happening until economists are listened to and we get a systemic solution to a systemic problem. That's all for today. Have a good day.